Let's talk about Stephen again, but start with a different premise. Let's assume that Stephen doesn't use a pass plan. With no pass, his business plans change a bit. His expenses are much less because he forgoes an equipment purchase in year one, spends less on advertising and marketing, and less on materials and supplies. However, without these investments in the business, sales revenue is projected to be lower. In this scenario, he doesn't make a profit in 2019. He loses $1,513. If we scroll down to cash flow, we find that cash flow is very tight until well into the summer. If we look at line 85, we see that Stephen ends the year with $877 in the bank. Projected sales needed to break even in 2019 are $621 a month, or $7,453 for the year. In 2020, his total sales increase, but modestly, Stephen is projected to make $574 in net profit in 2020, which means about $50 a month in owner's draw. He ends the year with $877 in cash. Break-even targets are roughly the same. If we click to the Closure Analysis tab, we find that Stephen would not hit the stability minimum wage threshold, which is row 10, in 2019 or 2020 projections. And this means that he would not earn a minimum wage equivalent for his labor based on net earnings and hours worked. Stephen would meet stability operating cash, which is 1 month's reserve of operating capital, in July 2019, here if we look at row 16. But he would not hit the threshold for closure operating cash, which is 3 months reserve of operating capital or cash in either years. Here we look at row 18 to see closure operating cash. Benchmarks 4 and 5 cannot be met without both stability thresholds, minimum wage and operating cash. But beyond the benchmarks, we do not want to help prospective business owners start businesses where we have no information pointing to an eventual sustainable net profit that is at least equivalent to minimum wage. With these projections, which was $877 in the bank after 2 years, and $50 net profit each month starting in the second year, it's hard to say that the business is worth Stephen's time, and it's also questionable whether it has sustainable cash flow for ongoing operations. In this situation, you would need to talk with Stephen, the team, and the VR counselor to begin working towards adjustments in the business plan that would make it more likely that the business would hit Texas VR's stability and closure targets. If you were working with Stephen, what are some things that you may suggest to try to help his business earn more net profit and accumulate additional operating cash?